So I'm almost positive at one time or another during your investing career, you have seen a chart like this, one that explains the power of dividend reinvesting. Now, this chart is accurate. This would be your returns with dividends reinvested versus not reinvested, but I think these types of charts give investors the very wrong idea about dividend reinvestments. They believe that they create additional value over somebody who is achieving the same return without dividends, and this just simply is not true. There is no added value from reinvesting your dividends on an equal level basis from an index that is returning the same. And I'm going to show you pretty much why this is true in a single chart. But first, I do just want to go over these charts in general and why they're misleading. As always, everybody, like the video, subscribe to the channel. Down in the description below, I have a report on 3 of my favorite stocks for 2025. You can grab that absolutely free. Now, the first main component to these charts and why I believe they're extremely misleading. So we have, how can dividend reinvestment affect investment returns? We have the blue chart, which is reinvested dividends, and we have the gold, which is not reinvested dividends. Now, the reason why this chart is so amplified is not any sort of additional return from the dividend reinvestments. It is effectively because in the situation of the orange line, you are receiving the dividends and effectively putting them in your pocket. You are not investing them. So as such, those dividends cannot begin to earn a return. So let's say you have $10 in your pocket that is earning 8% a year. Every year you take 50 cents out of your pocket and you stick it on the table. Now you have $9.50 in the second year that's earning that return. Obviously your returns are going to be lower rather than if you just kept that money in your pocket and started earning on that dividend payment. However, the error that a lot of investors have is the fact that they believe an accumulating share count, a larger share count, buys you more income, amplifies your returns. And what this does is it causes a lot of investors to chase investments that generate income so that they can buy more shares, believing that they're somehow compounding over and above somebody who is simply prioritizing total return and not just income. And this just isn't really the case. And the number one thing I want to go over a few videos and a few articles. The first one I want to go over is this chart here. So we can see dividends reinvested and dividends not reinvested. So when we come down to the chart here, we see dividends are used to buy more index ETF shares. These shares yield more dividends. The cycle repeats, fueling a positive feedback loop, in brackets, exponential growth. So what this might lead someone to believe is that reinvesting your dividends, you should try to earn more dividends so that you can reinvest your dividends and accumulate more shares. And I'm going to show you a chart of a very basic ETF here. I'm just going to show you that there's no additional value reinvesting your dividends over achieving the same total return on a percent basis. Now, a lot of people might believe that I'm talking that there is no value among reinvesting your dividends. There is value, but there is just no magical compounding value that's going to end up with you earning more over something that essentially has the equivalent total return. So this chart is going to pretty much put this theory to bed. So what we have here is Global X's S&P 500 corporate class ETF. It trades under the ticker HXS.TO. So what this fund aims to do, it is a total return swap ETF. So effectively Global X will go to a financial institution and they will say, give me the total returns of the S&P 500, including the dividends, and I will pay you a fee to do so. So if the S&P 500 returns 10% in 1 year, the bank will give Global X 10%, and in return, Global X will give them a fee in order to get that total return. Effectively, that is the total return swap contract we're seeing. These ETFs are a bit more in-depth than that, but this is just kind of what you need to know to understand how this works. So if the S&P 500 returns 10% 1 year, 2% of that being dividends, HXS will get 10%. They'll get a 10% return from the institution, and then obviously there's fees included. On the other hand, we have VFV. This is the Vanguard S&P 500 ETF. So this fund yields around, I believe it's 1.3% at this time. So what we're going to get with VFV is a much more traditional type of ETF. It holds the S&P 500 stocks. It owns the 500 stocks on the S&P 500. They pay distributions, and ultimately Vanguard pays out that distribution to investors. So what you'll notice right now is HXS has a much higher return than VFV over the last 10 years because it is just a pricing return. This is just a pricing return. So VFV, the reason why VFV has not increased as much as HXS is because the dividends have not been reinvested. So as we all know, or at least you should know, when a fund pays a distribution or whether a stock pays a dividend, the stock or the fund is worth less after they paid that dividend than it was before. So you're going to get a drag on returns when you're just looking at a pricing element because that distribution has been paid out and it hasn't been reinvested. So I want to go over a short snippet of a video, and this is not meant to pick on the person making the video whatsoever. I mostly just want to highlight the kind of incorrect assumptions on the power of dividend reinvesting. So let's listen to the video, and then I'm going to explain what I think here.
Compound growth is what makes dividend reinvestment so powerful. When you reinvest your dividends, you're not just earning money from your original investment, but you're also earning dividends on the new shares that you bought with the previous dividends. This creates a cycle where each year your investment grows a little more, and so do your dividends. The longer you stick with it, the bigger the impact becomes. For example, in the first year, your dividends might only buy you a small amount of extra shares. But as time goes on, those new shares earn their own dividends, which buys you even more shares. It's like planting seeds that grow into trees, which then produce more seeds. The snowball effect can turn a small investment today into something much bigger down the road. One of the primary reasons to consider automatic dividend reinvestment.
So the comments made here was the fact that you're going to receive your dividends, you're going to be able to buy more shares, which is ultimately going to give you, you're getting additional seeds. And in reality, that just isn't really correct. I mean, share count is completely irrelevant in all aspects. I mean, if I were to go through every single video from a dividend-based investor that just simply talks about how the fact that your dividends buy you more shares, this doesn't generate any additional return over and above what you would have earned if you just aimed to achieve the equivalent total returns. And I'm going to highlight that with this chart. So right now we have the pricing returns of VFV and HXX. Now what I'm going to do is I'm going to turn that into a total return chart. And what you're going to see here is that the returns, they're identical. I mean, there is a small difference in returns, but that is simply because of fees. So HXS, because it's that total return swap contract, it does have additional fees. Now, you might be thinking that VFE is automatically the better option just because of the additional fees, but there is actually some tax perspectives that I'll get to in a bit here that could actually make HXS a better option for you. But the one thing I primarily want to focus on here is that element of share count. So let's just assume you bought 1,000 shares of these funds in 10 years ago, in 2015. With VFV, you would have gotten paid out a distribution. You would have been able to utilize that distribution to buy more shares. Your share count would have risen. Whereas with HXS, because it doesn't pay a distribution, it effectively just returns you the total returns of the S&P 500 without any sort of distributions, nothing. You would have had the exact same share count you would have had when you initially bought the shares back here in 2015. And even though your share count of VFE has increased because of that, you're earning more dividends on those shares you own with VFV because, they paid out the dividend. You've been able to accumulate more shares. You're driving more distributions from those additional shares you own. It creates a misconception that you're compounding your dividend income. And when we look to this total return chart, we can see that the returns are identical. They're effectively the same over a 10-year period. An investor who bought HXS owns 0 additional shares that they did a decade ago compared to somebody with VFV who's slowly accumulated more shares over time with that dividend reinvesting. Yet at the end of this chart, we end up with exactly the same returns. So The power of dividend reinvesting comes from the fact that the funds or the stocks that you own, their value decreases after the dividend is paid out, and that dividend is cash sitting in your pocket. Whereas something like HXS, it does not pay a dividend. So there is no reason to reduce the value of the fund by the dividend paid. And as such, it just reflects the total returns of the index. When we look to total share counts, VFE is higher, HXS is exactly the same. You're not earning any, magic dividend compounding here. You're earning the exact same thing because share count, the amount of shares you own in an underlying company, is completely irrelevant. Total return is what matters. And when we look to a pricing level return, we can see this clear as day. If you were to take your VFV shares and not reinvest them, you would have lower returns. But this isn't because your share count isn't increasing. It's the fact that VFV is effectively worth less on a unit price basis after it pays out that distribution. So it makes sense if you were to reinvest that distribution, you have more shares, but your returns are exactly the same. If you are looking to build a dividend-based portfolio so that you can receive distributions and reinvest that into more shares, thinking you're having some added effect over something that returns the exact same total return without any distributions paid, this just isn't really accurate. And I mean, this is a poster boy of charts to kind of highlight that. Your returns are exactly the same. Somebody sat on HXS a decade ago, bought those shares and literally never touched it for a decade. Whereas somebody who bought VFV, they had to sit there and receive their distributions and reinvest those distributions into more units. And effectively, after 10 years, we're at the exact same returns. So what I would say the entire point of this video is don't structure your portfolio in order to receive income so that you can buy more shares and bloat your share count. Share count is completely irrelevant, highlighted by this chart that shows we end up in the exact same place anyway. The final thing I want to mention on HXS, because it is a swap contract with the bank that just gives it the total return, there is effectively zero taxes an investor would have had to pay over this 10-year period if they owned HXS in a taxable account versus VFV. So because HXS does not pay out any distributions, there is no taxes owed for the investor up until they sell units. And when they sell units, it's declared a capital gain. Whereas with VFV, if you owned it in a taxable account, you would pay taxes on that distribution in the year they were received. So I can't highlight this through Y charts, but if we look at the potential tax drag of having VFV in a taxable account versus HXS, we would see that your returns would actually be lower. So you would have paid taxes, you would have lost a chunk of your distribution every single year to the government, which would result in you being able to reinvest less, which ultimately would put HXS ahead here of VFV. So this is another added element to effectively try to structure your portfolio to earn total returns, especially in a taxable account. The least amount of distribution payments you can make in taxable accounts or dividends or whatever they may be, the more tax deferral you can do, and the more money you can have reinvested back into the market. HXS's fees are higher, yes, which is ultimately, in tax sheltered accounts, this has led to higher returns. However, if we think of the fees on a post-tax basis, depending on, your overall taxable situation as an individual, paying those fees, despite the fact they're being, 3% lower returns over a decade-long period, if you factor in the taxes, you might actually be ahead paying the higher fees with HXS. However, this is getting a bit off topic on the video. I mostly just wanted to point this out from a share accumulation perspective on the terms of dividend reinvesting. There really is no added value there, no magical compounding over and above what you would own achieving total returns. That's it for the video, everybody. I really hope you like it. I've been very sick the last week here, so I haven't been able to push out as many videos as I wanted. But again, like the video, subscribe to the channel, head down to the description there. You'll see the free report for 3 stocks I really like in 2025. We also have a dividend case study I will link to below. You can grab one, you can grab both. They're free content. Enjoy them, and I'll see you next time for more great Canadian content.